Hello, everyone. My name is Teresa Rickard, and I lead practice growth and marketing here at Jones Roth. I want to welcome all of the practice owners and administrators who have joined us here today for our healthcare webinar. But before we get started, I want to thank our generous sponsor for making this presentation and really our whole healthcare webinar series possible. The law firm Watkinson Laird Rubenstein provides a broad range of legal services to healthcare practices. With expert knowledge of the complex regulatory environment, their healthcare attorneys can help you navigate through the challenges of operating a healthcare practice. Today, we have the privilege of hearing from two of our healthcare practice advisors here at Jones Roth. CPAs Brian Newton and Jordan Dawley will be joining us, and they will be taking us through some of the key strategies for practices to be thinking about, especially as we get close to the end of the year. So we're going to be hearing them talk about legislation updates, best practices for financial operational management, and then they're going to walk us through a great year-end checklist that you can start using right now to make sure you're on track for 2023. At the end, we will have a Q&A session. So feel free to submit your questions in the question panel at any time throughout. It won't be too late to add questions at the end. And then just a quick intro to our firm. Jones Roth is one of the largest CPA and business advisory firms that is headquartered in Oregon, and we serve individuals and organizations across the Pacific Northwest and the nation from our offices in Eugene, Bend, and Hillsborough. And our healthcare practice advisory team specifically partners with medical practice owners and administrators like yourselves, offering a proactive practice success plan, which is our approach to providing year-round value to practice owners, maximizing operational and financial performance. So with that, let's get started. Brian and Jordan, thank you for being here with us today, and let's take it away.
Well, hey, Teresa, thank you so much for the introduction, and thank you to everybody for joining us today. We've obviously got a lot we want to work through with you today, and some of those items we're going to talk about include, as Teresa alluded to, some legislative updates. We're going to talk about some tax items, including what's known as a SALT workaround. Brian's going to shed some light in terms of how that works and how that's beneficial for you. And we want to talk about a few other business tax planning items, the new paid leave Oregon that's coming into play in 2023. And again, we'll talk about the year-end planning, some cash flow considerations for 401k planning, some other year-end items, W-2 reporting, things like that. So disclaimer, right? Information in this presentation is developed by the presenters. It's not an official position, right? It's deliberately general in nature. It's not legal advice, right? We should customize items that we discuss here to your fact pattern. And if you don't already work with us, we happen to know some pretty good qualified CPAs if you don't have one. So keep us in mind. All right, so let's move on to tax planning. There's a series of key bills that were in development over the last year and a half. The first of them was the Infrastructure and Investment Jobs Act. The main purpose of this bill was, as the name alludes to, infrastructure restructuring. But on the tax side, there was implications on the side of crypto tax enforcement. So if any of you have cryptocurrency, I don't know, imagine if you're allowing payment in that way, but if you hold them in the practice or the owners potentially have crypto, there is stepped up enforcement as a result of this act. There was other proposed changes that were going to impact the bill tax more broadly, I should say, via what was to be known as the Build Back Better Act. But we're not going to waste any more time on that because that did not catch the necessary votes to continue. So that's no longer in play. Replacing that was the new Inflation Reduction Act, the IRA as it's been coded. And these generally provisions within the IRA are not effective until 2023 and beyond, but there are some notable changes to energy tax credits. There are major changes in recent years, back from the Trump tax changes at the end of 2017, that will remain in place. So we'll talk a little bit more about the Inflation Reduction Act. So some of the changes implicated in there are some very high high-level companies, right? Not some that I certainly don't work with, and I don't imagine most of you are in this place, but just so you're aware, there's a new minimum tax of 15% for large C corporations with $1 billion of annual earnings over the last 3 years. Certainly like you to get there, but that's a long road for most of us to even be in that range. Probably one of the most popular items that's discussed in the Inflation Reduction Act is the increased audit activity, right? The IRS is to receive $80 billion of additional funds over the next 10 years to improve tax enforcement activities and technology. We as CPAs are actually kind of excited for the technology update. As you can imagine, their systems are kind of archaic and outdated. And certainly we hope for better resources for you guys as taxpayers, but also us as practitioners to better serve our clients. So it's not all bad. I know people have heard, right, that auditors potentially will be carrying firearms and banging on doors. It's not typically how they operate, right? That's kind of reserved for criminal law enforcement on the tax side, which wouldn't apply to most of you, right? So as I alluded to, a lot of changes in the IRA is related to climate and energy provisions. There's over $370 billion going to combat climate change with the goal of boosting domestic energy production. One of the aims of the IRA is to reduce carbon emissions by 40% by the year 2030. New to this act, there is a clean vehicle credit. The old law credit was for new qualified plug-in electric drive motor vehicles specifically. The maximum credit amount is $7,500, and there's certain vehicle requirements that need to be met. The bill changes specifically how this credit is calculated. Specifically, the vehicle has to meet critical mineral and battery component requirements, so it's a little more specific in that way. It also incorporates the retail price and is subject to income limitations by the purchaser. So there's potentially that you're too high of an income earner and you're no longer eligible for that credit. There is still in play some home energy improvement credits, right? That would include things like solar panels, energy efficient windows, water heaters, heat pumps, and HVAC systems as well. And then it also alludes to increasing opportunity for energy efficient construction, again, to mitigate climate change being one of the primary targets. There are provisions as well in the IRA that's specific to healthcare, right? So these healthcare provisions the IRA allows, I should say, Medicare to negotiate the price of prescription drugs and prohibit future administrations from refusing to negotiate on those prices. It also caps Medicare enrollees' annual out-of-pocket drug costs to $2,000 and creates a minimum for insulin costs at a monthly basis of $35, a maximum. It also provides free vaccines. Some of the additional provisions to rein in drug costs include a requirement that pharmaceutical companies that raise prices on drugs purchased by Medicare that are outpaced by inflation will actually have to refund the difference back as a rebate to the program. Again, on this similar topic, the IRA focuses to reduce healthcare costs for Americans in general across all ages. And one of the goals, again, is to reduce the cost of obtaining health insurance via the marketplace. We'll let Brian shed some light on our SALT workaround here.
Thanks, Jordan. Hello, everyone. We're going to spend some time on this topic because, for lack of a better term, this is really the big guy for 2022 tax law for mostly, if not all of you Oregonians here in attendance today. It does also impact other high income tax and income tax states as well. So we're going to spend a little bit of time on this. I'm going to start off just from the jump here. As we'll see as I work through this, it's more complicated than maybe it seems at face value. So please, please, please on this one, if you haven't already, are not already coordinating with your tax advisors, this is one you need to be jumping on more or less immediately. If this whole thing is very much news to you, it is something to immediately make action of. Some of us might remember the days of tax law when we could deduct all of our state taxes we pay against our federal taxes. Those were the good old days for some of us Oregonians in a high tax state. And we're probably mostly aware that a few years back, we limited that deductibility to $10,000. In other words, we can't deduct more than $10,000 of our state income taxes, our property taxes, et cetera, that all get combined together to that $10,000 limitation. We stop there at our individual tax level. So what Oregon has now done, and most other income tax states have now done, has allowed some taxpayers the opportunity to circumvent that limitation via paying Oregon tax from their business entity for any eligible business entity, instead of and in replacing, for the most part, certain amounts and requirements of paying Oregon income taxes to the individual owners. So I'll talk kind of broadly here about it first. Again, really most of the states at this point have enacted it, whether it was before 2022. Again, Oregon enacted it this tax year, 2022, with others with proposals in place to continue that motion forward here for other states as well. Basically, allowable PTEs, the businesses, pass-through entities, so generally speaking, our 1065 LLCs and partnerships and our S Corps, our 1120S filings, are eligible for taking this new election and replacing these costs. Some are ineligible. We won't get into a whole lot of those details, but obviously something to talk through with advice from your counsel about eligibility first for the organization itself. The way this new tax, we'll call it, works is we pay 9% to Oregon of our first $250,000 of net distributable proceeds, and then 9.9% of the amount above 250. And it's important to note here that that's per entity, not per owner. So those limits don't compound with per owner at the first 9% of 250. And it's based on the entity itself that elects into this new PTE program. So again, it's the PTE stands for pass-through elective tax for Oregon and other entities as well. Some people call it the SALT limitation. SALT stands for state and local tax. So if you hear that acronym, it's all referring to the same thing. A quick example just to show that really this is important and it can be quite powerful from a tax savings perspective to really make sure that people are exploring this new option if they aren't already. An example, if we have an LLC medical practice that nets $900,000 and has 3 owners, and let's just for simple math say each owner is $300,000 of that 9, the total tax to Oregon through this new elective tax is $86,850. That's $22,500 for the first 250, $64,350 for the $650,000 above the 250 net income. Let's assume each individual owner has a federal tax rate at 35%. The savings federal tax wise for that becomes $30,000 roughly, or $10,000 per owner. So real money saved, $10,000 in each owner's pocket, absent our historical more recent tax law. So it is impactful numbers, and of course the higher that number grows, the more tax savings there are. The easy quick question says, Brian, why would I spend $86,000, $87,000 to save 30 in federal taxes? Well, again, a reminder, it more or less replaces our income tax paid at the individual level. So in other words, instead of paying the $87,000 individually, we're paying it from the business itself. So we're not adding to the tax by electing into this. We're replacing effectively the individual income tax to Oregon, which is effectively the same amount, more or less how that's determined as well. So again, a quick map here of the states that have enacted or in the process of enacting, etc. It was up there for a minute. We won't spend too much time there, but just that resource is there as well. So Jordan, you can jump to the next one for me. So a little bit more information here and considerations as we explore this new PTE option that people need to be aware of, and again, explore how it impacts their own practice or themselves, etc. effectively. There's possibility for disproportionate benefits among owners. So in some cases, you might have to explore how does it benefit each owner, and does that have to be trued up or recognized or realized in some fashion. It's going to create more allocations because, again, it does pass through to individuals potentially differently. So it really has to be explored how it also operationally impacts the organization when you look at income allocations and distribution allocations, right, and determining how much really belongs to each owner, et cetera, which sometimes has to happen after the fact, after tax filing. So there's administration to deal with around this as well, especially as we move forward and start reporting this for the first time for 2022 tax returns. There are considerations as well if you have any non-resident of Oregon owners that might interact differently for a non-resident versus a resident of Oregon. Again, won't go into too much specifics there, but something to be aware of and talking about with your advisor as applicable. Other really important considerations, right? It's not too uncommon that in tax law we have tax changes, updates, modifications that require us, or should encourage us at least, to re-explore how we're set up as an organization, right, structurally. So this is another one of those where you should revisit structurally if there's a consideration for changing how we're set up, how that might look for us. If we're ineligible, especially, it might be an opportunity to say, hey, is there something we can change to make ourselves eligible for this that's effective? An easy example could be if I'm a single practitioner with a LLC, and therefore right now I file on a Schedule C tax return, Schedule C on my individual tax return. Perhaps there's an opportunity there to create a partnership or create the S Corp instead to take advantage of this, because a Schedule C is not eligible to take advantage of this like a pass-through entity is for others. An eligible multi-tier organization, consideration strongly of where you make the election. So an easy common example here could be if my medical practice is an LLC, partnership by tax law, but I also have S Corp MDPCs in between that actually own the LLC, where do I take the election at? Is it going to be at my 1065 level, or is it going to be at my S Corp level? And that's not necessarily going to be the same correct answer depending on the group specifics either. Broadly speaking, you will tend to get a larger tax advantage by electing at your 1065 LLC level than you would your S Corp level, because you're going to end up paying more PTE tax, therefore offsetting more of your individual Oregon tax obligation. Broadly, because the LLC does not expense the wages that are processed through an S Corp, so your distributable net income is a higher number, therefore the tax to be paid and then credited to the end owner is a higher number than at the S Corp level. The potential negative sides, though, to that decision is more complexity oftentimes, because we're going to run into more allocation considerations, because you're going to have one entity dealing with multiple impacted individuals versus oftentimes the S corporation is a one-to-one scenario, so it's usually a little bit more simplistic and straightforward. The other oftentimes could be cash flow concerns or considerations. We would be paying more on the example of doing it at the LLC level, and oftentimes potentially overpaying, because we often have additional expenses at the S Corp level that would reduce further the true tax obligation of the end individual taxpayer. So potentially it would also create a scenario of overpayment and having to wait for either refunds or the benefit of overpayments applied forward in subsequent years. So that is a consideration, as well as what would be the cash flow impact of different decision making, not just purely the tax impact of these decisions. So again, it just highlights this isn't a simple answer. It's a complicated item that you really need to be talking about and figuring out what's the best option for me as an organization or me as an individual, etc. Other really important consideration, go back for me, Jordan, please, on that last bullet point, could be awareness initially of all the entities I might be involved with, who is or is not electing or can't elect into this new election. So easy examples are, if I'm involved in a rental property partnership, is it electing into it? Can it elect into it? Because if it cannot or is not, then you're still going to be on the hook individually for your Oregon taxes. You can't just assume that you're covered, and you don't want to get a tax surprise because you're just assuming that they're also going to pay Oregon income taxes on an owner behalf. Similar with surgery centers. Some surgery centers might be ineligible for electing, some might be eligible for electing. So initial step is finding out and having awareness of who truly is going to be electing into this, so you can again work with your tax advisor to kind of know what's coming here, honestly, at this point, as soon as April 15th, because if everyone's covered, that's a different answer than if some can't elect in for our business. So again, really important to be aware of all those moving parts that we have. Now we can jump to the next one for me, please. One other clarifying, actually, there, I had one more note on that last piece, is the taxable income for the individual to pay to Oregon, or how much Oregon income tax the individual will end up paying, is so contingent on which entities elect in or out, right? So if I elect in for my business, the likely scenario is I don't have to pay Oregon taxes individually related to my income from that business. However, if I have a surgery center, another entity, or investment income as a scenario that still gives me income that I can't elect a PTE on, I'm still going to have to pay taxes individually related to said income. So again, awareness on that topic is super important, so that you know and don't know, for lack of a better term, exactly what you are going to be obligated to pay at your individual tax level as we migrate through this new opportunity. SALT workaround, decision-making, implementation, right? There'll be a little bit of repeats here potentially, but communication, whether your practice will or won't elect, right? Groups need to get together because it's an entity decision, not an individual decision. In Oregon, it's all or nothing. So each partner is either in or out in a scenario. You can't individually decide to take advantage of it, and others do not. Estimated payments, again, we spoke to it a bit, but they're really important to be aware of how it impacts your personal estimated Oregon payment requirements. And again, your federal payment requirements, because it should benefit you in most cases of electing into this for your federal taxes. So presumably the requirement of paying federal tax estimates should drop as well. Cutoff calculations and allocating short year ownership is important. So if we have ownership changes in the part of the year, then it's going to be allocated separately or differently for those part year owners. Again, something to be aware of and in front of, so that all those disproportionate allocations are dealt with correctly and fairly. And then a big one is timing considerations for how and when we make payments. So some of us in this call still might remember those days, again, going back to the start of my conversation here, that we had a time where oftentimes your tax advisor would say, hey, pay your Oregon fourth quarter estimate before the end of the year. The broad reason was then it becomes deductible on a cash basis taxpayer for the year it's paid. So that's a big consideration as we approach this year end is, am I better to look at estimating and paying towards this aggressively or non-aggressively before we hit January 1st of next year? Or am I looking at maybe wanting to defer the payment to next year? Broadly speaking, that decision making should really be a lot around expectations of income this year versus next year. In other words, the general rule of thumb is if I have a down year in 2022, I might actually be better to push that deduction, wait and pay more of this tax in next calendar year to the extent I can be able to do so via tax law. But the opposite also holds true, that if I am going to have a great year this year, I know I'm already going to be in maximum tax rates for this year, going ahead and prepaying as much as you reasonably can in the current year likely will serve of great value, because you'll get the deduction right now versus essentially having to wait till your 2023 tax year to take the federal tax deductible benefit of the actual payment date of making such estimates. So again, a lot to absorb, a lot to go through. We don't expect you to have followed completely and understand completely all we just went through. Just really wanted to highlight some broad specifics and say, make sure if it's not already something that you are discussing, approaching, attacking, and deciding on at this point, especially very quickly if you haven't already done so.
That's well said, Brian. One other thing I'll throw in is that we're fortunate, right, in the state of Oregon, and that these payments made via the pass-through tax elective are refundable credits to the individuals when they file their individual return. So if there is a slight overpayment, they'll actually get that back as a refundable credit. Whereas there are some other states, California being one, where these are non-refundable credits for the course of 5 years, right? So potentially an overpayment could be on the books in writing for 5 years before there's potentially a refund of that. So thank you, Brian, for shedding light on that. So we'll move on. Another popular item I'm sure you've all heard of at this point, or at least I hope you have, is the employer retention credit. This is still in play. We can still apply for it, so be aware. It's beneficial, right, to see if this fits your scenario. One thing we wanted to bring your attention is essentially a warning, kind of a big heads up that there are, I don't know if I'd say scam artists. That's probably a good term, but they're certainly helping people claim fictitious credits. And the IRS has actually also raised alerts about this, and they're cautioning taxpayers to be careful who they engage with for this credit. There have been some, right, who charge a fee contingent on the amount of refund they generate for you. So obviously their incentive is to generate as much credit as possible, thus charging you a higher fee likewise. The big issue here is that most of them, right, won't be around to support you if there was an audit on your credit. So a huge risk from that standpoint. So I recommend you talk with your practice advisor to see if this tax credit is eligible for you and get assistance with calculating that credit. So there's a few common myths with the employer retention credit. The first would be, right, that people thought that if they got the PPP loan, they would not qualify. And this initially was correct, right? Employers could not qualify for both initially when the PPP loan first came out. They then released at the end of 2022 the Relief Act, which changed this rule retroactively all the way back to March 27th, 2020. And this allowed eligible employers to not only claim the ERC, but maintain forgiveness on their PPP loans. And any wages, though, that were paid for with the PPP loan can be considered eligible. However, they do not count for purposes of the credit in terms of wages that were paid during a shutdown period with PPP funds. Other people do think at this point that it's too late to apply. There's a 3-year sunset in terms of claiming a refund in a tax eligible period. So at this point, we're creeping up. June of 2023, we'll be approaching the phasing out of the credit for the Q2 of 2023, or excuse me, of 2020. So you still have time to apply for past credits, 2020 and 21. So be aware that you do still have time to execute that. And then newer businesses, right, were in fear that like they wouldn't qualify because their business was not active at the time. They did carve out a startup business eligibility for this. The businesses that started in 2019, the quarter that they used is the quarter that the business began is used as the base in terms of measuring your quarterly decline, and until the business reaches a full year of operations. So for example, a new business that started Q2 of 2019 would use the quarter use that quarter as the base to determine the revenue decline, either Q1 of 2020 or Q2 of 2020. You get the option there. And then if the business started in the middle of quarter in 2019, an estimate of the period's gross receipts can be used, which is unique to this specific scenario. And then other people do think, right, that they did not have enough of a quarterly decline to qualify. 2020 was an initial 50%. The 2021 credit, right, because there's credits for separate years, the 2021 credit is based on a 20% decline compared to 2019 over that same quarter of 2020. So, or excuse me, 2019. So the credit is, a lot of people qualify when they didn't originally think they would. So here's just a nice reference chart you might bring back and kind of when you're looking at your books to see, right, if you're in this category. Hopefully your tax preparer and your practice advisor has talked to you about this already, but this would be a good year-end item to make sure that's revisited if you haven't already taken time to consider that. Section 179, right, this gives you an opportunity of advanced deduction for assets you place in service. If you're purchasing assets totaling $1 million, actually $1,080,000, they're eligible Section 179 property. You can consider whether it's appropriate to take full depreciation if you have the necessary income to offset, or if it's ideal for you to stretch out the depreciation over a longer time period. Then on the front with 100% bonus depreciation, you also consider, right, the advantage of this write-off without proration. Even if you only have the asset placed in service near the end of this year, you'd be able to fully depreciate the entire value to offset the income in the year you purchase.
I'm going to jump in there too really quick, just because of my topic being the PTEE tax discussion. It's important too to be aware, again, hopefully something that your tax advisor upon preparation of tax returns is going to be aware of and factoring in for decision making and reporting, but also related to PTEE, our net distributable profits or proceeds is not reduced by Section 179 deduction. It is reduced by 100% bonus depreciation deduction or bonus depreciation deduction. So there actually is a decision to be made potentially of what system is utilized, because it can impact also what the PTEE resolution or final determination is. Again, oftentimes, if you're looking at maximizing the best federal tax benefit, there's an opportunity potentially to take Section 179, which actually pragmatically happens kind of secondarily to the bonus depreciation unless it's elected out of from taking the bonus depreciation. So that is potentially a miss this year if folks take bonus depreciation when they otherwise potentially would have been better off to take 179, even though it's kind of second in the ladder, generally speaking, in a process perspective, when it might actually elevate the ability to deduct more Oregon taxes for personal tax reasons and therefore paying more PTEE tax.
Yeah, thanks for adding that, Brian. That's a great point. So next up, right, is our de minimis safe harbor election. This allows a business, right, to set a bar in terms of de minimis purchases they make of equipment, right? This typically speaking would be a $2,500 limit. Any small tools, incidental tools would be an expense in the current year instead of being added to your asset listing. You also want to consider your business interest to see if interest paid and incurred is subject to any limitations. This limitation applies to taxpayers with gross receipts over $27 million in year 2022. So be aware that that's in play if you're above that threshold. So some of the year-end things we talk about in regards to accelerating income and deferring deductions. This comes in play as well for corporate taxpayers, right, that are anticipating potentially a small NOL for the current year and substantial income for the next year. So the possibility might be, if you're able to consider accelerating just enough income from next year into this year, if possible, to offset that NOL in the current year. This will also permit you to base your estimated tax installments next year on a relatively small amount, right, shown on the current year, rather than having to pay estimated taxes 100% of a much larger next year taxable income. So another thing we wanted to talk about is Paid Leave Oregon. This is a new program that's being implemented January 1st of 2023. You should all be aware of it at this point, hopefully. This is a payroll tax meant to cover covered leave for employees, right? So your requirement as an employer is you need to alert your employees about Paid Leave Oregon so that they're aware of it. Then you need to remit and report employee wages for those employees who work in Oregon and your employee counts to Oregon, both for, employees for Oregon, employees who work out of the state. And then you need to withhold the employee portion of those contributions or cover those contributions for the employees as an employer offered benefit. The tax is 1% of employee wages up to $132,900 per employee. And if you have under 25 employees, there's no employer portion to pay. The employee pays 60% of the 1%. Once you're above 25 employees, the employer picks up the other 40% of that 1%. The idea with this program is that it requires an employer to essentially hold a position for an employee who is taking qualifying leave in the course of 90 days or more. So keep in mind some of those nuanced rules there. You can also use what's called an equivalent plan. So if you were to use the Oregon plan, right, you're contributing to the state's run program. An equivalent plan is a plan, right, that the Oregon Employment Department has approved and which provides benefits that are equal or greater to the state's program itself. There's no deadline to submit your equivalent plan, but to ensure timely approval by January 1st, right, ideally you'd already have that in, or you'd be sending it in very soon to be sure Oregon Employment Department had time to review and approve that plan. If the employer administered equivalent plan, right, there's potentially cost savings there. You could use a fully insured equivalent plan, essentially an outside insurance policy to cover it. There's potentially cost savings there. So you might talk with your insurance professional and see if they have an equivalent plan that fits you right and potentially saves you some money over that contribution amount the state of Oregon requires. All right, so next we want to talk about some year-end checklist items, right? Some year-end reporting items that are key for your practice. W-2 reporting items are probably the most obvious one, right? If you're an S corporation, we need to make sure owners' health insurance premiums get added to their W-2s. It's a mandatory reporting requirement for greater than 2% shareholders, and it actually allows us to take what's called a self-employed health insurance deduction on their individual tax return. So if that's not reported, we will require an amended W-2 to properly pick that up. So ideally, that's included in the initial reporting. Other ideal things to capture now, right, would be any personal use of company autos. Make sure that's provided to your payroll company ahead of your W-2 processing. And then lastly would be checking payroll to make sure your owners are on pace to maximize their retirement deferrals. This year the limit is $20,500 for an individual, and then once you're above age 50, you could get to $27,000 of deferrals. So it's possible to run a bonus payroll for those owners to make sure they hit the maximum deferral amount. We just talked about Paid Leave Oregon. Obviously, I would run up the ladder to your payroll company and make sure they're aware that you're ready to implement, either if you're using the state plan or an equivalent plan, because that does need to be implemented January 1st of next year. Again, employee retention credit, right? You want to make sure that that's front of mind if you have not already applied. Bring that up to your advisor and have that consideration run by once more as we're growing closer to the 2020 credit being phased out, right? Sooner the better in that situation. And then again, right, there's more information on the pass-through tax elective. I know Brian spent a great amount of time discussing kind of the nuances there. Hopefully it's piqued your interest if you already have not considered it. We'd certainly like to be a great resource to you in that regard. So keep us in mind if you have any technical clarifications in that regard. So some of the other opportunities year end is we like to make sure practitioners and administrators are aware of the qualified business income deduction. This actually is a benefit on the individual tax return, right? There's phase out limits for it. So high income earners actually get phased out of this deduction. But if you're in the sweet spot for the deduction, it's a 20% deduction against your business income, right? So that's a pretty sizable deduction on the individual tax return. And that's part of our planning strategy we do is try to, if possible, help an individual get into the range where they're able to get this deduction because it can be a pretty powerful deduction. We've already touched on the interaction of 179 and bonus, so I'll let Brian's comments be the kind of final comments on those there. And again, a reminder, right, we've got that safe harbor election for small incidental purchases of $2,500 or less that can be expensed immediately and not added to your asset listing. So make sure you're aware of any maybe future needs you have in the next couple months of 2023 and any items you can capture now to offset current year income. We also talked again a little bit about business interest expense limitation, right? If you're over 27 million of gross income, we'll need to look at your business interest potentially being limited. And then again, we just want to remind you, right, that this is the time to implement deferral related retirement funding and be aware of contribution goals for 2020. Obviously, those can be funded up until tax return is filed, but you want to make sure you have the necessary cash on hand to hit the contribution limits that you guys have set as goals for your owners. And then one final thing, right, we talk about, right, is accelerating income and deductions. This is not only applicable to C Corps, right? We talk about year-end running projections, seeing where your income's at, and maybe there's deposits you receive in the mail towards the end of the year that you wait to open and process early 2023. And likewise, if there's supplies and things you intend to buy, say early January, you might think, or even early to late January, that you might consider purchasing now to offset again the current year income you've generated. So,
and again, on that one, it's always an important reminder that the opposite can hold true as well, right? It's the general rule of thumb that, you know, deduction today is better than a deduction tomorrow. But if I had a low tax year for whatever reason, which maybe that's more common these days with coming out of a pandemic and ramping up again, et cetera, but I expect to be really high in net income next year as I'm coming out of these things, you might actually look at the opposite, right? You might have to defer a little bit of a tax benefit, but if I can take a deduction at a 35% tax rate versus a 24% tax rate, you know, that's more valuable to take the deduction at a higher tax rate, because I will save more dollars in the tax deductibility of such payments. So, while generally speaking, accelerating income or accelerating deferrals and deferring deductions is actually how we have it written, right? We want to look at the timing based on our expectations of the current year and the next year. Another sidebar I have a little bit is a reminder. We see it oftentimes. Folks are making, you know, if they're looking to accelerate deductions, making year-end purchases of near-term equipment needs, right? I might be buying a $50,000 medical equipment piece that I need to get, and I know I need it within this next 6 months, but maybe it's not urgent. Reminder that you have to actually place those assets in service to make them deductible in the current year. So keep in mind, if that's a decision point, that's really needs to be quick potentially, because you might have to wait for it to be delivered and make sure it's ready to be used. It doesn't technically have to be used, but it has to be ready for use before the end of the year to be able to deduct it in the current tax year as well. So that's a subtle one that sometimes you run into issues with, because folks make that decision on, you know, right after Christmas, but you don't have the time. You really need to get it actually all the way there to place in service for tax law.
Yeah, great point, Brian. Well, Teresa, we wanted to see what kind of questions have accumulated, see if you've got any things you want to interject and send our way.
Yeah, definitely. Let's see. So here's a question. If owners utilize the pass-through entity elective election, do they no longer make personal estimated payments at all?
Good question. So it depends, we'll call it. So I kind of gave a scenario before of multiple different entities, right? Let's say I have a scenario where I am an owner in a medical practice, and I'm an owner in a surgery center, and I am an owner in a commercial rental building that I self-rent for that medical practice, and I have investment income and interest and dividends and capital gains. If my practice elects in, generally speaking, that should essentially remove requirements to pay taxes related to that income. And if my medical building rental property also elects in, I should likely not have to pay any individual estimates to Oregon based on that income source. But if my surgery center can't or does not, and my investment income, it's not eligible to take against investment income, I would still have to consider and have a personal Oregon tax obligation that's going to be attached to that income, because those entities or the investment portfolio is not paying for that tax itself anymore. So there could be a myriad of scenarios that can create the scenario of having no requirement individually. There could be some that mean you still have substantial Oregon estimates to be made depending on the individual taxpayer. Another kind of trigger point that creates for me that to be aware of is I gave earlier a scenario of our multi-tier LLC then S Corp scenario. We might also be able to explore in that scenario if we're going to elect at the LLC 1065 level for the PTE. I might not even have to make withholdings to Oregon for Oregon income taxes on my W-2 anymore, because the PTE would potentially cover my tax obligation attached to my wages as well. So the quick answer, of course, is now after all that, it depends and really needs to be looked at closely again to maximize as best we can our tax scenario, but also to make sure that the surprises don't exist in our tax world and we think that we're covered, but suddenly we have a substantial obligation on April 18th because our 15th, sorry, because I went ahead and assumed I'm not going to have any payments because that's what I understood about this thing, and I get a surprise because I stopped paying any individual estimates.
Right.
Again, sorry, going to jump in again. This
Yes.
is all Oregon, right? All Oregon,
Right.
or all other income tax state potential payments. Keep in mind, federal taxes will be reduced a little bit because that's the whole purpose of this opportunity, but you're still going to be looking at your federal individual estimates just to make sure 100% clarity there are going to be necessary continually, more or less how they always have been, but with maybe a little bit of an impact reduction because of the tax benefit.
Awesome. Thank you, Brian. How about an expense-related question? Generally, if an administrator replaced the chairs in the waiting room, for example, and it costs $7,000 in total and $500 per chair, can that be expensed or does that need to be capitalized?
You want to take this?
Yeah, the individual unit cost is what's important there, right? So if it's $500 per chair, technically it's below the safe harbor, the minimum safe harbor amount, so you could expense it all in the current year. Yeah.
Okay, how about, is it true that funds received from ERC are taxable income to the practice?
I'll go with what Brian likes to say, it depends, right? Actually, yeah, so the ERC, if you were to be eligible, apply and receive that credit, say you applied and received the credit for the tax year 2021, and you received it this year in 2022, it would not be income in this year when you receive it. Instead, it's an adjustment to the payroll taxes you claimed as a deduction back in the eligible credit year. So in this case, you would need to amend your 2021 tax return to reduce the amount of payroll taxes you claimed by the amount of the credit. So kind of in a roundabout way, yes, it is taxable income in that way. However, the state of Oregon actually passed a law that it's non-taxable. So when we do these amendments, we amend and add the subtraction or reduction of the expenses on the federal return. On the Oregon return, we actually add it back as a subtraction to offset the adjustment. So for a net zero change to the state of Oregon for this.
It's an important thing to be aware of, the amending portion. So if you do determine now on the back end eligibility of a prior tax filed year, it's important to be aware that it does require amending, as Jordan indicated, which says if I have a larger practice, so again, it might still be well worth the money of the credit, even when you factor in potentially the additional taxes owed on amendment as a result of the additional taxable income, it would be a project, right? So just keeping that in mind, if I have a group with 20 owners, you would technically have to amend the pass-through entity tax return, and each individual would be looking at the requirement of also amending their individual tax returns because their income would go up in the amended tax year.
Great. Thank you both. I do not see any more questions in the panel, questions panel. If someone still has a last question they want to sneak in, oh, there we go. There is one. If ASC structure is LLC and reinvests profit, is profit taxable for entity?
So I'm ambulatory surgery center, I assume. So read that again to me one more time, please, Teresa.
If that structure is, if it's an LLC and they reinvest profit, is the profit taxable for the entity?
I think I understand what the question is alluding to. So if I understand the question, so I'll kind of reiterate it, then the answer is yes. Or in other words, if I'm taking it and needing it for cash flow as a reinvestment because we need better cash flow, then yes, it would make net taxable income more. You're not going to directly pay tax on the amount held back for reinvestment, we'll call it, the amount not distributed. So there's not going to be a scenario where you pay tax on the income, then tax also on the funds that are, instead of distributed out, are reinvested to the business, where it actually could be a tax benefit as an alternative. So if it's not reinvested into necessary operational cash flow and not distributed, but reinvested into, property and equipment that's depreciable or deductible, it might not be till the next year, but that becomes tax deductible, potentially in the following tax year. So I don't know if the question provider wants to respond, if that was what they were alluding to in their question, or potentially can clarify it all just in case. I want to make sure I was answering.
Yes, sure. He says thank you. So we'll assume that did address the question, and so thank you, Brian. All right, well, let's wrap the Q&A up for now. As always, you can reach out to us through our website if you have additional questions, and I really appreciate both of you taking the time to be with us today and share your expertise with our clients and community. We really hope all of you who have joined us today have taken something new with you. I also want to mention one last thing on our last slide here. We have a healthcare salary survey that we are co-sponsoring with the Medical Executives Healthcare Forum. And so if you are interested, and we encourage you to do this, please visit this webpage and download the survey spreadsheet, fill it out, and submit it through our secure upload. All that information is on the page, and you will receive the report of the salary survey, and it provides great information just from a geographical region across various specialties, across the different counties. And we really hope to grow the audience for this survey over the next couple of years so that it can become more and more valuable. So please fill it out, participate, and share it with your colleagues so that we can continue to do this survey. All right, well, thank you so much to everyone who's joined. I hope everyone has a great afternoon, and we'll see you next time.
Thank you, everyone.
Thank you.